In today's class, we will try to see the first how the investors who are inclined to behavioral biases will construct their portfolio, though it may be closer to the portfolio we construct as a rational investor, but you will finally see that these are not consistent with how a rational investor should construct his portfolio. And after seeing the example of behavioral portfolio construction, we will try to see some behavioral biases that which are exhibited by the people when they make investment or when they make decisions. And there are two classifications of biases according to our reading, though you will see different types of classification in different parts of the literature. And we also have shared the classification that some biases are kind of cognitive biases, some biases are kind of emotional biases. So in today's class, we will try to spend time to understand the cognitive errors, which are more related to the information processing errors, and we will try to see that how can we uh, find out the ways that how to detect that we are exhibiting these biases in our decision making process, and we will try to discuss some suggestions that how can we overcome uh, these biases so that we will follow the approach of making decisions like a rational decision maker. So let's begin with an example for behavioral portfolio construction. The principles of behavioral portfolio constructions are presented in the previous class. So you are seeing an example where there are two investors who are behavioral portfolio theory followers, that they are behaviorally biased, or they uh, the portfolio manager acknowledge that they do have some behavioral biases, so that you need to address those biases to uh, construct their portfolio. So the portfolios will contain at most three layers. So we already have shared in previous class that instead of looking at a uh, single layer behavioral portfolio, look at the portfolio from three layers. The first layer will be very uh, riskless investment or risk-free category, or you may conclude that it is kind of zero risk layer. And second layer will have a moderately risk investment, and a third layer or final layer which will include highly risk speculative investment. So for different layers, the investors will attach different types of goal. So for riskless investment, say investors will take his goal such as he wants to maintain a decent lifestyle. So he needs some monthly expenses, he needs some monthly flows. So he'll try to attach his that kind of goal with this kind of layer, the first layer where there is a riskless investment. And there may be some goals uh, which are not kind of very regular type, and it's not kind of very high aspirational. For example, you want to have a house after 10 years, or after 15 years you need to have your own flat. In that case, you can look at some moderately risk investment, and the final layer which encompasses the highest risk speculative investment, you can take some very high aspirational goal that you need to have a personal yacht within 5 years or within 10 years. For that purpose, you want to maintain this layer. So for different layers, the expected return with the associated probabilities are given. So as already has been mentioned that layer 1 has no risk, so its expected return is only 1%. There is no risk information for the layer 1, and the moderately risk investment has expected return of 3 -3% with 10% probability, 5% with 80% probability, 9% with 10% probability. So you can easily get the weighted average of this portfolio layer 2 return by making weighted sum. And the speculative investment, which is in layer 3, it has three possibilities: 15% return, 15% probability for -50% return, and 50% probability for 12% return, and 35% probability for 75% return. So from this divergence of the return, you can easily expect that why the layer 3 is recognized as the layer for making a speculative investment. So we have two investors. First investor has 2 million euros in his hand, and his aspirational level of 2 million euros with a probability of 100%. So what does it mean? It means that the first investor uh, does not want to compromise any penny of his wealth. I mean, he whatever his capital gain or capital loss or whatever the outcome is, he always tries to maintain his 2 million principal investment. He does not want to lose any of this principal investment. So from this from his perception or from his aspiration that he wants to maintain his original investment in any cost, in that case you can conclude that he does not have any tolerance for incurring any loss in his wealth, so that uh, he can maintain his original investment or original principal or capital with uh, no risk. So out of layer 1, layer 2, and layer 3, which layer would be more in which layer he should make investment and in which layer he should not make any investment? Before going for further discussion, let me ask you this question.
So he should invest in layer one.
He should invest in layer 1.
Yes, sir. Only
Okay.
in layer one.
Okay. uh, is there any family member among us that who has this kind of aspirational level? He or she may compromise for having any positive return, but he or she has a kind of perception or aspiration that he or she does not want to lose anything. Is
Yes,
there
sir.
any
Yeah.
example from our family,
Yes, sir.
our siblings, father or mother, or we ourselves?
Yes, sir. Our father and mother.
Both.
Yes, sir.
If I ask you to pick anyone between our father and mother, which one you will pick first for this kind
So
of?
my father.
Your father.
Yes, sir.
Okay. What about others' opinion? That your father or your mother is very risk averse, that he or she does not want to lose anything, though he or she is will be ready to compromise any kind of return, but he or she does not want to tolerate any loss from his original investment. Any response from other? No response.
Yes, sir. My mother.
Your mother?
Yes, sir.
Okay. Any other response? Third response. We have got one support for father. We have got one support for mother. Anyone with different option that both my father and mother have the same kind of aspiration level that they do not want to lose any single penny?
Sir, mother.
Your mother. Okay. So you're getting more support for our mother. And I will also, if you ask me that, I would see that my mother is more kind of the first BPT investor we see in our example. Okay. So BPT is behavioral portfolio theory investor. Okay, it's kind of just acronym to make you understand that uh, the investors exhibit some behavioral biases and they are trying to construct portfolio according to the behavioral portfolio construction process or procedure. Okay, the second BPT investor has 2 million euros, I mean the same level of wealth, and he wants to make investment, but he has a special level that he wants to have some return on his investment, and that is 2.1 million. So if you calculate this 0.1 million over 2 million, you will see that it is kind of how much percentage, that how much return he wants to have. Is it 5%? 1 million over, sorry, 0.1 million over 2 million?
Yes, sir. 5%.
Okay, 5%. So with a probability of 8%. So he wants to make sure that in 80% cases, he will have this amount of wealth, 2.1 million. Further, this investor also has shared his opinion that how much loss in his wealth he can tolerate willingly, that he can tolerate up to the portfolio level of 1.8 million. That means his 2 million portfolio can go go below this 2 million, but it cannot go below 1.8 million euros level. So at least 1.8 million euros need to be maintained in his portfolio. That means he has no tolerance to loss beyond this point. Okay. Then construct the optimal portfolio for the first BPT investor. In addition, evaluate whether the second BPT investor's portfolio is optimal. If the investor puts 1.568627 million euros in layer one, and the 431,373 euros in layer 3. So we have been given a suggestion that if second BPT investors make investment in this way, that this portion in layer 1, this portion in layer 1 and this portion in layer 3, will it be possible for this second BPT investors to achieve his aspirational level and to protect his risk tolerance level? So there's a difference between this concept of optimal portfolio we use in this context and the optimal portfolio we use in the classical finance context, that you can recall that if we have the efficient frontier in this way, and if your indifference curve is like this, you would select making investment here, or uh, if your uh, indifference curve look like this, you would select making investment here in the efficient frontier. And we also try to solve some mathematical problems to get that how much we need to make optimal investment, or how much consumption we need to make for getting optimal allocation. But here we optimal portfolio, we are trying to mean that the portfolio which fills his aspirational level will be known as his optimal portfolio. So we already have solved that first BPT investor. For the first BPT investor, if he invests 100% of his wealth in the layer 1, he has no chance to lose anything. His investment will remain at 2 million, and he has a wealth level after getting this return 2 million plus 1% return. So his optimal portfolio is layer 1. But for the second BPT investors, we have been given some suggestions for allocation. Let's see the suggestions that if he make investment of this amount 1.568 million, it will be 78.43% of 2 million. And the suggestion includes that there will be no investment in layer 2. That's why the allocation is 0%. And in layer 3, he wants to, if he makes investment of 431,373, it will be 21.57% of his allocation. So you can calculate the expected portfolio return in this way, what you learn from the statistics. But what we want to see that if he makes investment in this way, is it possible that he will be able to he will be able to have a lower exposure? I mean, the portfolio will be within 1.8 million euros when there is a risk, and if it is possible for him that to maintain the 2.1 million euros as which is his aspirational level. So for this case, layer 1, there is no probability, there is no risk. Okay, so certainly he can have a 1% return. So how much investment he is making in layer 1? This amount, 1.56867 million. Okay, so if I write this figure here, 1,568,627, and the investor is expecting to get how much? 1% return from this layer 1, and there is no investment in layer 2, so there is no chance of including this in the total return calculation. And how much he made investment in layer 3? That is 431,373. 431,373. Okay, but there is a probability for different returns. I have summarized the returns in here. These are some expected return percentage: minus 50% with 15% probability, and 12% with 50% probability, 75% return with 35% probability. Okay, now if I consider the first case, if it happens, the first one, we need to multiply this in this way: 1 minus 0.50. Okay, can you calculate this and let me know the figure here? The first case. How much he will possess if the first possibility is the real possibility, is the real thing happens?
Sir, 1800 000
18.
00
Okay, I mean the 1.8 million.
Yes, sir.
Okay, now it is one case that he has a 15% probability that he has a 15% probability that his portfolio will result in this amount of wealth. There's a how much probability? 15%. And there is no question about the probability of this part. This is completely certain. Okay. Now, if we took the second case, what is the probability? 50%. The probability is 50%. How much return we will get? I mean, in total. In that case,
12.
there will be 2 million. This amount. If there's a 50% probability, and if these things happen, in that case, there will be 12% return. Okay. But if the case is the third case, you will calculate this, that there will be how much return? 75%. For this, there is a probability of 15%. For this, there is a probability of how much? 50%. And for the third case, where the return is 75%, you will see the calculation will give you how much it is. As it is a 75% return, it will be a big number. It will be 2,339,216. Okay. So what is the probability for this? 35%. Okay. Now we want to check that whether his aspirational level for return and risk can be satisfied by this possibility. That okay. First of all, we see that in any case, his portfolio is at least above the 1.8 million. It is not below the 1.8 million, right?
Yes, sir.
It is at least in any of these three cases, it is at least 1.8 million. I mean, his the objective, that the safety objective, which one? That he cannot tolerate the portfolio declining below 1.8 million euros. It is perfectly satisfied.
Yes,
His
sir.
safety objective, his risk objective or safety objective is perfectly satisfied with this allocation. So with this allocation, it is perfectly satisfied. Okay, then next one is his aspirational level. Aspirational level for return. So he wants to make sure that he will have 2.1 million euros with a probability of 80%. With a probability of 80%. But you see that there is a 35% probability for having this wealth. And when we see that he wants to make sure that he will have 2.1 million euros, okay. So there's a probability, it is perfectly above the 2.1 million, but the probability is 35%. But it is this 2.067 million is below the 2.1 million, and this probability is 50%. So we can say that in 85% cases, or it is 85% likely that he can have at least 2.067451 million wealth in his portfolio. But we cannot make sure that he will have at least 2.1 million wealth with 80% probability. Can we make can we make claim like this, that he will have a 2.1 million wealth in 80% cases from this understanding?
No, sir.
But we can make sure that at least in 85% cases, he will have at least how much wealth? 2.067451 million wealth. So we see that there is his aspirational level cannot be met perfectly. With his return, he can make sure that he will have at least 2.067451 million wealth. But for getting 2.1 million wealth, is it higher than this? This one, his aspirational level 2.1 million wealth, is it higher than this?
No, sir.
2.1 million is higher than this. What is now possible with 85%?
So 2.1 million is higher.
Right. That's why I'm asking that 2.1 million is higher than the level of wealth what is possible with the current portfolio construction. So what would you suggest that how can he increase this wealth level by making more investment in layer 1, or by having some investment in layer 2 or layer 3, by taking some investment from layer 1?
So by taking some investment from layer 3 to layer 2.
By shifting some investment from layer 1. I mean, you already have wealth in layer 3, which will give you the higher return from the layer 1. And to get a higher value of this, I mean, you want to make sure how much? You want to make sure that you have at least 2.1 million wealth. That means you need to increase your return. So how can you increase your return? By shifting some investment from layer 1.
স্যার লেয়ার 1 থেকে শিফট করলে যদি মিনিমাম 1.8 মিলিয়ন এই ক্রাইটেরিয়াটা ফুলফিল না হয় তাহলে স্যার একটু দেখতে হবে।
Okay, but we need to make some rearrangement. We need to make some rearrangement. Okay.
Yes, sir.
By making some rearrangement here and here, you will see that you need to check that still that risk objective and the return objective can be suitably met. Okay, but the issue is that if he does not want to, if he does not want to change his allocation, he does not want to change his allocation, he needs to change in his safety level objective. Because that when you go for making investment more in layer 3 and layer 2, what will happen? There is also more chance that portfolio will decline below this.
Yes, sir.
When you are taking more risk exposure, and when you are wanting to make more return, you also need to prepare for more risk. In that case, you may not maintain this safety objective level. Okay, so you need to make adjustment here. Or alternatively, you can also change this also, this one, 2.1 million aspirational level. If you say that my aspirational level is not now 2.1 million, rather my aspirational level is this 2.067 million. In that case, do we need to make any more rearrangement?
No, sir.
Okay. So in this way, there are different possibilities. There are different allocations, different way of allocations, and there is no perfect allocation, but we need to make sure that we have constructed portfolio in a way that meet the investors risk objective and the return objective. So have you noticed that we have not considered any kind of covariance here? We have forgot about the covariance of covariance between layer 1, layer 2, or layer 2, layer 3. I mean, we have not considered the portfolio in aggregate. Rather, we are considering the portfolio from different layer perspective. Have you seen this kind of in case of efficient portfolio construction? that your objective will vary? Have you seen that a single investor will have different risk objective, different return objective in efficient portfolio construction or in classical portfolio construction? We assume that a portfolio cannot have any layer. A portfolio is a single portfolio. We need to consider in aggregate, and we need to think from the aggregate portfolio perspective and what is happening to the aggregate portfolio risk and what is happening to the aggregate portfolio return as a whole, not in this way. Okay.
Yes, sir.
So let's continue for understanding the behavioral biases of individuals that investors, or not only investors but also the asset managers, most often exhibit when they make financial decisions, not for themselves but for their employers or also for their clients. Okay. So uh, classical finance always asks us to make rational decisions, to consider all the options and to evaluate all the options using the base port base theorem, and also all other mechanisms that the rational decision maker should do. But we already have recognized in several classes that we do not make decisions in that way. We make decisions in our own way. So in behavioral finance, we try to concentrate on that how people make decisions in real life, rather than how the economics or finance ask people to make decisions in this particular way. So when people are experiencing some decisions which require collecting a good amount of information, making a complicated analysis, and use statistical techniques, use some computer machineries to get a good decision, people most often use shortcut. People most often do not try to use their brain rationally. People in such situation try to use effort, that amount of effort which is less than the optimal effort they need to make, they need to spend. So in that case they make decisions. Obviously people always make decisions, but their decisions become far from the optimal decisions. So there are some forces, there are some factors which are responsible for making people to decide in such a way. And we try to understand those forces as a behavioral biases, what individual decision maker exhibit. So I already have given one example that when you decided to enter into University of Dhaka, you had a plenty of information for University of Dhaka, but you didn't make any effort to collect the information for studying in other universities. So you are biased to have admission in only these universities. But later, when you are right now in this university, you are now considering that you had a chance that if you had this information, or if you had collected this information, your decisions would be different. You would study in different university. So this way, this thing happen in our life regularly. So we need to acknowledge this issue, and we need to make decisions. We need to make decisions very which will be close to optimal. And we need to have a knowledge that if anyone tries to influence me to make a decision which is not the right way of making decisions, we need to acknowledge that, or we need to have a knowledge that that influence need to be avoided. So what is the purpose of knowing these behavioral biases? We as a investment professionals, we need to have a good understanding of these biases, because of not showing these biases by ourselves, but by making or by exploiting these behavioral biases which are exhibited by the people. Okay, so let's say if I ask you about the sentiment, that people has some mood, people has some feeling, people has some uh, good or bad uh, feeling about something. Okay, so if I ask you that what is the current sentiment level in the financial market right now, in the stock market specifically, is it very positive, moderate, or negative?
Yes, sir. Positive.
Positive. Okay, anyone feels that the average sentiment of the investors right now in the stock market is moderate or negative?
Sir, above moderate.
Moderate. Okay, there is no option between this positive
Sir,
and
it's
moderate.
moderate.
Okay, okay, I mean no one is trying to say negative. Okay, but be careful that investment professionals need to act differently from the crowd. Okay, so when there is a high sentiment, when there is a high sentiment, people want to shift their investment from real estate, from bond market, from bank deposit, from savings certificate. People try to sell off their investment here and to make investment in stock market when there is a positive sentiment in the stock market. What is the likely response if it happens? What will happen?
It's a bubble.
The market will be overvalued. The market will become overvalued.
Yes, sir.
So investors are very likely to increase their investment in the stock market in this point of time. In the last year, after March 18, or yeah, after March 18 probably.
Yes, sir. March 18.
Yeah, so after that time the sentiment was negative. The sentiment was negative, or the sentiment was not very warm. So if you had made investment in that time as an investment professional, right now this is the time to make sell. Okay, when
Yes,
you
sir.
bought your portfolio, or when you invested heavily in your portfolio during the negative sentiment time,
Yes, sir.
so you are acting differently from the investors crowd.
Yes, sir.
So if you don't understand that whether the current sentiment of the investors right now is positive, and we need to uh, uh, give a reverse play. We need to have it. We need to just have the opposite position. In that case, if you don't understand this timing, you will not be able to capitalize this. So the understanding of behavioral bias is not to help you to exhibit your behavioral biases or to learn the behavioral biases. Rather, need to recognize that there will be a timing when the investors in general will exhibit some biases, and you need to make the decisions in a way so that you can capitalize on the opportunity created by the exhibition of the investors, exhibition of biases of investors in the market. Okay, so we are not giving stress right now here. We will talk about more later. So you have got the purpose that as an investment professionals, what is your purpose to know about the behavioral biases? Okay, and it is not only the general investors who exhibit behavioral biases. There has been numerous research who documented that the sophisticated investment professionals and hedge fund managers specifically, also exhibit sometimes behavioral biases. And also in corporate finance, if it is behavioral corporate finance, it has been observed that CEOs are in general overconfident. So overconfidence is good in corporate finance.
No, sir.
So
Bad.
sometimes overconfidence is good, sometimes overconfidence is not good. But if you look at the history, or if you look at the story of successful CEOs, they will conclude that they are, to or some extent, they are overconfident compared to their peers, compared to their colleagues. That's why their overconfidence rewarded them to become CEOs. Okay, but obviously there are some failed stories. But if you ask the successful stories that which factors have made you CEOs, you will see that in some point of time or in several points of their career, they are overconfident. But it has been in behavioral corporate finance. Okay, but in asset pricing and invest portfolio management, I mean behavioral asset pricing, behavioral portfolio management, behavioral asset pricing, behavioral portfolio management, overconfidence is always injurious to your uh, health of the portfolio. Okay, so at the same time, overconfidence and the underconfidence are equally dangerous. Okay, so we need to have the confidence, but we need to avoid the overconfidence, or we need to avoid the underconfidence. Okay, so we also gave an idea that behavioral finance has two perspectives. One is micro, another one is macro. In micro perspective, we try to discuss the forces or factors which uh, influence the individual decision making, which are different from the rational individual's decision making. We try to discuss those factors in behavioral micro perspective. But in macro perspective, we try to focus on how in aggregate the real market behaves differently from the efficient market expectation. So we talk about this in macro perspective of behavioral finance. Okay, so you have got the initial idea that what we are going to discuss in the subsequent slides or subsequent discussion. Okay, so we already have mentioned this in the very beginning of our chapter, that we can classify our biases into two broad classification. One is cognitive error, another one is emotional biases. So you already have mentioned that uh, these cognitive errors are more related to the way that how our psychology helps us to make decision, and how our brain works, and how we use our statistical tools, and how we filter our information. And these forces sometimes sometimes influence us to make decisions, and we see those decisions are different from the optimal decision. So that's why those forces are known as cognitive errors. And alternatively, emotional biases are not related to this, which emotional biases are related to something that we sometimes we make some decisions that gives us more pleasure, and that gives us less pain. Okay, uh, say uh, you have been a you have been a very you have been a very bad performance in the exam. In a final exam, you have been in a bad performance. After getting out from the exam hall, you are trying to convince yourself, or you are trying to console yourself that the question was very difficult, or there is also possibility that question was easy, but you didn't prepare well. Okay. Which option, if you pick, will give you more pleasure, less pain?
So the question was hard. This
Question
option.
was hard, question was difficult. The sir didn't teach us well, and he gave us so many questions about which he didn't explain in class. These things. So you immediately thinking of these things, right? So what is the reason? The reason is that if you think in this box, it will give you more pleasure, it will give you less pain. Okay. So this kind of biases, what people do always to avoid pain and to produce pleasures themselves are more or less known as emotional biases. More or less emotional biases. So say the overconfidence is a kind of emotional biases. Overconfidence is a kind of emotional biases because the overconfident uh, individuals produce pleasures by themselves when they make decisions, by taking some decisions which gives them more pleasure. Okay. So say you have been able to have a good gain from your recent investment. So you did you did good analysis for making this investment, but subsequently you have increased investment in the same position, but it is likely that you didn't make the appropriate analysis in this subsequent decisions. So from this return, from this recent return from the same investment, you have become overconfident. So you want to give you more pleasure by making investment in that stock which has given you a good return in recent times. So when people make investment in this way, they try, sometimes their behavior represents some overconfidence. Okay. And people sometimes have overconfidence on their existing position, but there are also debate on this, and uh, will talk about more when we'll discuss the overconfidence. Okay. So the cognitive errors are related to statistical thinking or statistical processing, and also related to how we process our information in the memory, and it also results from some faulty reasoning. So we show you some faulty reasoning in the previous class, that uh, people are likely to make inconsistent decisions. So their decisions are not similar uh, when we present the same statement in different ways. So we'll talk about the framing bias in this class, and you need to acknowledge that this kind of errors, cognitive errors, can be corrected by training the investors or by providing knowledge to the individuals. Okay. For example, can you recall the probability class from applied statistics? Can you recall the probability class we did in the applied statistics?
Yes, sir.
Okay. Uh, is your memory very fresh about the probability concepts right now?
So motamoti.
There are different rules. There are different rules, and we saw different aspects and different scenarios where probability rules differ. It looks like the scenarios are different, and we tend to use the probability but later we see that we are using the probability not in appropriate way. The probability rules are different. Can you recall the Bayes theorem? Bayes formula? I see no response from you. Probably you, many of you are taking breakfast together. Is it? Or I'm disturbing your breakfast? Okay. The issue is that we do mistake in these statistical things. It's not like that we do mistake intentionally. We do mistake unintentionally. For example, there's a formula for Bayes theorem to adjust the existing probability with the recent information or with the new information. But if we mistakenly use the Bayes formula, I mean, we do mistake in using the or in writing the Bayes formula, our outcome will be wrong. So in that case, what can we do? We can review our probability learning and we can train ourselves again, and then we can make appropriate decisions. So it can be easily corrected that if your biases arise from some information processing or statistical processing, okay, so if you are aware of this errors, you can make correction on that. But the emotional biases, say, it has been found that the males are in general, I already have shared with you that males in general have been found much more overconfident than female. Okay, so it has been found that one indication of the overconfidence is that the trading in the brokerage account of males are much more higher than the trading frequency in the brokerage account of females. So overconfident investors make excessive trading, buy, sell frequently, sell, buy very frequently, compared to the female investors. Female investors wait for a longer time and they think twice, thrice before placing a buy order or placing a sell order. So do you think this kind of emotional attitude of male and female can easily be corrected? It comes from the nature, it comes from the kind of insight, emotional attitude. What do you think? Can it be easily corrected?
No, sir.
Okay. Our mothers are more emotionally attached to us compared to our fathers.
Yes, sir.
Can it be reverted
No, sir.
by giving any training that by telling our father that you should act like our mother, or you should act like my mother, that you should have more emotional feelings like for me? Or can we train our mother that you should have less emotion like my father? Can it be corrected?
No, sir.
Because it comes from some uh, impulse which are kind of intuitive, okay, which comes from their inner feelings. Okay, so in today's class we like to spend our remaining 1 hour for learning the cognitive errors which are more related to the statistical processing or memory processing or information processing. So we can classify, according to our reading, we can classify the cognitive errors in 2 different categories. One is kind of belief preservance biases, another category is information processing biases. Okay, so in belief preservance biases, from the name it implies that we try to remain stick on the belief what we are currently holding, instead of having new information, or instead of having solid information that our belief should change or our belief should be modified, we do not like to do this because of uh, having some biases. Okay, because of having this belief preservance biases, so we do not like to modify our belief. So these biases are known as belief preservance bias. And another category, information processing biases. Information processing biases are not kind of related to belief, rather it is more related to how we make processing of information in our mind, that sometimes we are very inclined to talk from a number, or we start making decision by thinking from the past numbers, and we do not like to say we do not like to uh, think of some absolute numbers. We try to relate the new number from the existing number. So we'll try to learn more about it when we'll give a specific example of information processing biases, that when we make decisions, we have some heuristic, we have some mental shortcut, or we have our responses get different when the question is asked differently to us, whether although the questions are same. Okay, so first of all, in belief preservance bias, the first bias we like to concentrate, that is the conservatism bias. Okay, so it is most basic or common type of bias we exhibit, that is we try to maintain the existing views or existing belief instead of availability of new information. We do not like to uh, change our views. Say, this bias has both statistical perspective and also the perspective from the information processing. Okay. First of all, let me give you an example so that uh, you will get the remaining ideas. Okay. Okay. Have you seen the uh, this kind of price graph?
Yes, sir. Yes, sir.
Okay. Can you tell me that it looks like the recent price of Robi? Have you seen the recent pricing trend of Robi?
Yes, sir.
Okay. Have you seen that there has been a discrepancy in their information disclosure?
Yes, sir.
That on 24th of December, they disclosed that uh, they have renewed their license for 15 years, but on January 4, they corrected their information, saying that it is not 15 years, but it is 10 years. Okay. So the information which has been appeared on the 4th January, which has been available on 4th January, has people adjusted their belief? You see, this is the January 4th, the point where I am selecting, or where I have selected. You see, this is the January 4.
Sir, this chart is misleading.
Why?
Sir, the actual chart should be broken, sir. Sir, প্রতিদিন স্যার just jump করে স্যার, মানে continuous line না।
Obviously not continuous line, but I'm taking the closing price. Obviously, it is not continuous price, continuous trend if you look at the daily price movement. But I'm taking the closing price only. If you take the closing price, is it upward trending always?
Yes, sir.
Okay. So what I'm trying to say that when on the January 4th, Robi has issued new information, which is not a positive information, which is a kind of negative information. Why it is negative information? Because earlier they told that it has been updated for 15 years, and for 15 years the amount of cost they have paid has been disclosed. But when they subsequently disclosed that it is for not 15 years, it is for 10 years, your valuation will change. Your valuation
Yes, sir.
should change.
Yes,
Yes, sir.
sir.
So in that case, what it should be. And
So the value should go down.
you also need to recognize that as they have done, it is a kind of issue that people have shared, that is a kind of the lack of governance there. Okay. So but it has been seen, you see that there has been no adjustment in the closing price. There has been no adjustment in the closing price. I mean, people have not adjusted their existing belief about the Robi even after having the new information that was not available earlier when they made their valuation. Okay. So in addition, it has also been found that uh, even if there are some small indication that the disaster is coming for this company, a small indication, people do not try to, or analysts do not try to pay heed. So analysts do not try to adjust their target price. They tend to believe that this will not cause any major changes in their valuation. This kind of very small indication. But later, when there has been a gross information disclosure and there is no way to refute that disclosure, on that time, analysts only adjust their target price. But when analysts adjust their target price, the disaster already happened. The disaster already
Happened.
happens. Okay. So that this also happened during the time of financial crisis. There was some indication that financial turmoil is coming, but analysts didn't pay heed. Analysts tried to believe that there will always there will be increase in the price of real estate. Okay. So the thing is that when we exhibit conservative biases, what we do, what Bayes has told us, when there will be new information, you should give weight to the new information in your
Yes, sir.
existing probability.
Yes, sir.
In your existing probability, there are two components. One is existing information, another one is new information. And if you do not properly weight new information, what you are doing, your weight is one. What you are doing, you are overweighting existing information, you are underweighting new information.
Yes, sir.
So that is how it is related to statistical processing. Okay. So the thing is that what is the consequence when we exhibit conservatism bias? Okay. We are very slow. We do not like to update our belief with the new information. And if it is true, what we do, we like to we do not like to take a mental stress by updating our belief. You see, for example, say Right now, Robi is trading more than 60 plus today.
Yes, sir. 62.
62. Okay. So you know very well that on every day, regulator is asking Robi that is there any information which you have not disclosed behind this unusual price hike? Robi is every day reporting that we have no undisclosed information for which the price is unusually hiking in the market. So Robi itself does not know why the price of 10 taka has reached to 60 or more than 62 or 63. Robi itself does not know. It does not have a new information. Okay. So when the company has disclosed that we do not have any information, any new information which can be justified to this recent price hike, what would you do? You need to question this price.
Yes, sir.
What finance has taught us, price will only move when there will be new information, right?
Yes, sir.
Okay. So instead of having new information, why the price is continuously going up, we do not have any answer. We do not have any answer. So an analyst, for example, you are an analyst. So when you have found that Robi has disclosed an information that it has done a mistake in disclosing its information. It's a spectrum uh, renewal period is for 10 years rather than 15 years. Okay. So when you made valuation for 15 years, say for that time, your valuation target price was 15. But when you see that the renewal period is for 10 years, if you adjust this 10 years, let's assume that it will cause the target price from 15 to 13. But do you think that this adjustment is very easy? You have made a big analysis, you have done a good number of reports, you have distributed the reports to your client, you have given presentation to your company that the target price is 15. Target price is 15. But when there has been this new information, if you want to update all these things and you have to redo all of these things, you have to justify that my target price should be updated. Is it the way you need to go?
Yes, sir.
Yes, sir.
Will it cause mental stress to you?
Yes, sir.
So do we love to take mental stress always?
No,
sir.
you don't love to.
So that is how that we do not like to make adjustment for new information. We try to ignoring new information is very simple, and it gives us it helps us to avoid this kind of mental stress. Okay, so how can we overcome
স্যার
this?
স্যার
Yeah.
তখনও তো স্যার একটা মেন্টাল স্ট্রেস মানে থাকে না যে আচ্ছা আমি এই ইনফরমেশনটা ইগনোর করতেছি দেন তার মানে তো আমি হচ্ছে যে আমি একটু রং ওয়েতে আগাচ্ছি তো এটাও তো ব্যাক অফ দ্য মাইন্ডে থাকার কথা এটাও তো এক ধরনের মেন্টাল স্ট্রেস
Okay, but people most often does not look at this long-term consequence of making this mistake in the short term. That's why this is bias. Okay,
আচ্ছা
but as a rational person, you need to recognize that if we ignore this kind of new information, we need to have a very negative consequence in coming days. Okay, in that case, you can easily overcome this bias. The way what you just have mentioned, that is the way that how can we overcome this kind of bias, that if we do mistake, it will have a long-term consequence. I may go out from the job market. Okay.
জি স্যার
So there are some suggestions. First of all, we need to be aware that we do exhibit this kind of bias, and we also need to, we already have mentioned that if there is a cost that involved with the updating of information, and if you see the cost is very expensive, that if you go for adjusting the new information, the cost only not in the monetary cost, monetary and non-monetary cost. If you see this cost which are necessary to make new effort, in that case you will try to be less likely to update your belief. But if you see, it is very easy that if you just do very small effort, you can make updating, and it is not very significantly cost involved. In that case, you will be very likely to update your belief. Okay, and you need to always ask yourself that how this new information changed my forecast. And if you see that I do not know how to adjust this new information because this information seems to be very new, very unique, you do not have the knowledge that how can I adjust this new information or how to accommodate this information into my valuation Excel or valuation spreadsheet. In that case, what can you do? You can seek advice from the professional that how can we make adjustment, or whether in which field we need to make adjustment for this new information. Okay, next one, confirmation bias. That is interesting, that people, as a people, we try to uh, we are very tend to be selective in picking up the information which supports our belief, and we try to ignore the information which or which is in contrary to our belief. For example, we prefer to make investment, say, in Singer. Okay, let's talk about a very new stock. We prefer to make investment in Walton. Okay, so if you look for information in the market about the Walton, not only in the financial market, in every market, I mean the market in which Walton plays, okay, the industry, you will see several news. Some news are good news, some news are bad news. There are so many information. Okay, but it has been found that if people people are very selective in picking up the information, say an investor has said that his valuation for Walton is 800. So it has been found that he wants to pick up those information which will justify his belief that its target price is 800, and he is likely to discard those information which he does not believe that that will keep the target price at 800. So if he feels that this information which are in support of my opinion about the Walton, those information are positive, and if I see the information are in contrary to my belief, I see those information are negative. Though the information can be positive, but according to my belief, as these are different from my belief, that's why I term those information as negative. Okay, so it is very popular in the academic research that researchers are very likely to exhibit confirmation bias. Say you have learned that farmer discovered that small stocks gives higher return compared to big stocks, right? Size premium, have you heard about it? Learned?
Yes, sir.
Okay. Now, for example, you have picked the sample of, say, what should I say? That you have selected the Asia. Asian market, just for example. So by doing the similar research, what Pharma did, you have found that big stocks are providing higher return than a small stock, just for example. But in that case, researchers are trying to, researchers will be in a big challenge. Why researchers will be in a big challenge? Because it is well and widely accepted, this one. So researchers will try to modify his research in a way, statistical methodology, he will try to adjust his methodology in a way so that he will get the same kind of findings what Pharma got in Asian market. But in reality, it might be different. Have you got it?
Yes, sir.
So this is the way how researchers exhibit the confirmation biases. And if we see that some information are in support of us, we try to pick those information and we term those information as positive, and the vice versa for the information for which we feel that those information will not support my belief. Okay. And it has been found that uh, sometimes you will get influence, undue influence from your client to include a stock in his portfolio, though you have found that it is not good to be included in his portfolio, but your client is continuously influencing you to include that stock in his portfolio because he has a confirmation bias for that stock in different ways. Okay. So how can we, what is the consequence of having this? It should be confirmation. It should be confirmation. What is the consequence of having this confirmation bias? The consequence is that as we are very selective in picking the information, in that case, what we will try to conclude, we will ignore any information which is negative. We will only include the positive information. In that case, my updating will be partial or full. Updating of the information or updating of the existing belief will be partial or will be full. If we ignore the negative information,
So partial.
it will become partial. In that case, my updating will not be appropriate. Okay. And we also try to, for making confirmation, say, what people do, what analysts do, say, there are some selection criteria, say you are doing right now, that you will screen out some stocks based on price earnings, based on price to sales, and then sales to cash flow,
Dividend
or
yield.
in this way. Okay. So say for a particular stock, say for Robi, all of these are negative. I mean, it has not been selected based on this benchmark, right?
Yes, sir.
So what analysts try to do, analysts try to include a unique metric here based on which Robi will get selected, because he wants to confirm that Robi is a good investment. So he tries to make his selection criteria in a way so that Robi will not be discarded from your selection. Okay, that is way how analysts customize their screening criteria to include their preferred securities. Okay. And when it is that true, what you will do, you will end up making investment in a very risky stock, or you will make investment in a stock and you will place weight which is more than the optimal weight. You will be overweighting in a particular stock. So what you need to do, always you need to ask information, you need to look information which is in contrary to your belief, which is always ask your belief and which is always tell you that your belief may not be right. You need to look as obviously your good information are with you, but as you are inclined to or you are tend to ignore the negative information, you need to ask for this information which challenge your belief. And you also need to make some corroborating support. What does it mean? It means that say based on price to earnings ratio, you have selected a particular stock. Say, what stock should I mention? For example, you have selected JMI.
Yes, sir.
But you have to confirm your selection by making some alternative analysis. For example, you have done some technical analysis, you have done some fundamental analysis to conclude that your selection is good or your selection is appropriate. Okay, so when you will get consistent support from all of these criteria, your selection will be appropriate. Okay, then the representativeness biases, it is also the kind of bias which is in the category of belief preservance bias. People are tend to when people are faced with new information or new thing or recent thing, people want to classify those things with the existing experience or the prior experience or prior categories, though these new information are absolutely different. So these categories have been made by people themselves in their mind. For example, what should I say? For an example, say a particular stock, stock A, you have analyzed the stock A and you have looked at its features, but you are not very sure right now that whether it is a growth stock or value stock based on the information right now you have. But what you have done, you have included in stock A into the category of growth stock, assuming that or thinking that as a stock A looks like stock B, and stock B is a growth stock, that's why stock A should be growth stock. In this case, you have not made thorough analysis because of having some problem, or because of you didn't have the plenty of information, but you had to compare, you tried to compare A with B, and by thinking that stock B is a kind of representative of a stock A, that's why you have included stock A as a growth stock.
So এটাই তো আমরা মাল্টিপল বেসড ভ্যালুয়েশন টেকনিকে স্যার এই অ্যাপ্রোচটাই তো ফলো করি স্যার।
In the valuation we do that, but when you are categorizing, when you are making categorization, you what you do in growth stock and value stock, how you categorize the growth and value stock? If you have the information of price to earnings ratio, which stocks will be in the growth stocks, which stocks will be in the value stocks? The stocks which will have a very low PE ratio will be categorized into growth stock, and the stocks which will have a sorry the stocks which have a very high PE ratio will be included in the growth stock, and the stocks which have a very low PE ratio will be included in the value stock. Is it the way how we classify the growth stock and value stock?
Yes, sir.
Okay, so say the earnings of the stock A is negative. In this way, price earnings ratio will tell you any meaning?
No, sir.
It will not tell you any meaning. So what can you do then? You can do some alternative way of including alternative way of looking at the stock A to be for making inclusion in the growth and value stock. So in this way, if you do this without making thorough analysis or due diligence, what you will do, you may mistakenly you may mistakenly think that stock B is representative of stock A. Okay. And another thing is that what we do, that say for some stock in which category I should say, that in pharmaceutical and chemical, you see some selected stocks, say only ACI, only Renata. These stocks are performing well, and all the other stocks are underperforming. So based on this ACI and Renata performance, you have concluded that pharmaceutical and chemical sector is outperforming in recent days. What will happen? Your sample is representative of the universe of pharmaceutical and chemical sector. You have selected only Renata and the ACI. In that case, will your conclusion be appropriate?
No, sir.
Your conclusion will not be appropriate. Okay. So it is in that case, you will also see one example from here for representativeness bias, that people will try to give more weight to the recent information. People forget about the existing or base information. Okay. So it is a kind of, say, a company, a 50 years old company in the automobile industry. And it has been observed that in these 50 years, there has been the companies in the industry had turmoil, had some good years. But over the 50 years life, there have the companies which failed, they tried to overcome, and successfully they have been able to overcome. But in recent years, there has been several headlines in the newspaper that automobile manufacturers are having some difficulties in their business. So the person who has a representativeness bias, he is likely to forget the 50 years history when there has been success and failure, and most of the automobile manufacturers have been able to overcome these cycles. A person who is exhibiting representativeness biases, he will try to conclude that this stock, APM company, will also fail. It will go out of business and the stock will become valueless. But if you are not exhibiting representativeness biases, you will collect the information for all 50 years, and you will see the chance of getting out of business is least likely, and APM company will be able to revert to their mean, and the stock will again be a value stock. And you have learned from your financial analysis and valuation that in stock market there is a tendency that uh, prices prices tend to revert to the mean. If it is very if you think that this is a kind of mean, and when the price is very high, there is a tendency that it will go to mean, or if the price is low, it will have a tendency to go to the price at a mean level. Okay, it has been found, and there is an evidence for in support of this, and there is also evidence against of this. Okay.
Yes, sir. Market correction.
Okay, yeah. So how can the representativeness biases has implications for us in terms of consequence, and how can we overcome these biases? The first thing is that uh, people have a tendency to make their decision exclusively on new information or a small sample. And if it is why people do not go for looking at the base information, looking at the long history, because there is a problem, there is a mental stress when you go for updating complex data, a long history, long 50 years, you may not feel good, or it will take much time, and you want to employ less effort, these things. Okay, the thing is that always you need to ask yourself or ask ourselves that are we overlooking the reality of the investment situations being considered? So we do not need to uh, concentrate heavily on the recent, concentrate heavily on the new. We also need to take the big picture, that what are the possibilities that can happen. Okay, and also we need to have a very long-term perspective for making the portfolio, and for looking at the portfolio return and the portfolio performance. And we have to construct a diversified portfolio, and which is important, you have constructed a portfolio, but if you are not stick with that portfolio, it will have a negative consequence on the performance of your portfolio. So you need to have a stick uh, with that. Okay, next one is illusion of control. Yeah, from the perspective, from the term, you may have an idea that people tend to believe that they have uh, control, they have a control on some uncertain thing, some probabilistic event, though their control on that probabilistic event is very unlikely. However, people feel that they will have a very control. Okay, it has been found that when there has been a lottery, in evidence, if people have been given the chance that there is a box to select the lottery from the box, and when people are given chance that people will each people will be able to select the coupon from this box himself, each individual who are participating in the lottery, they want to give higher price for the lottery compared to the lottery in which the individual participants will not have the chance to pick the lottery. So do you think that the person who will pick the lottery has a control on how he will select the number from the 1,000 or from the million coupons? What do you think? He has any control here?
No, sir.
But he wants to pay higher price if he has been given chance to pick a lottery from this box himself, because he is a participant. So it has been found that people pay higher prices for this kind of lottery. Okay, so these are some kind of illusion people have. The thing is that when people have this kind of illusion of control, what people do, people trade more than what is prudent, especially the online trader. How many of you are online trader?
Sir, I am.
You are online trader. Okay. Anyone? Okay, I am also online trader, and I do trading using trading 212, and I also do trading using the iBroker. It is in the international market, and it is in the local market. So I feel that as it is very uh, near to me and it is in hand and it is very closer to me, that's why I am very prone to make buying and buy and sell using this platform, compared to if these are not available, I should call the broker and I should mention that what I want to do, what I want to buy or sell. I would think thrice or twice more compared to this situation. What do you think?
স্যার
Yes, sir.
Okay.
স্যার
Anyone wants to ask?
স্যার একটা প্র্যাকটিক্যাল কোশ্চেন স্যার, আমি বাংলাদেশের যে কোনো ডেবিট কার্ড অথবা ক্রেডিট কার্ড দিয়ে ইন্টারন্যাশনাল স্টক এক্সচেঞ্জে ট্রানজাকশন করতে পারবো?
The thing is that you need to have account first from the broker. So when you will be given information, when you will be you will give information to the international broker. If he satisfies with the documents you are giving, you can open the account first. Then by using the credit card, you can transfer the amount to that account, but there has been mentioning of no purpose, which is kind of investment. I mean, the Bangladesh Bank has mentioned some purposes for which the balance in the international debit card or international credit card issued from Bangladesh can be used. But by hiding that information, by hiding the purpose of making investment in the international stock market, you can transfer the balance, the maximum limit for probably 300 for a single endorsement in the credit card so far. But in the debit card, the endorsement limit is higher. So in that way you can do, but that is kind of unofficial.
ওকে
Okay,
স্যার।
but you need to make sure that you get the clearance from your brokerage. I mean, you can contact with the international broker or online brokers, okay, by sharing your documents. So if they are satisfied, they create account for you. But I do not feel that if you have a bank account in the international bank, I mean not the local bank, okay, if you have the international bank account, in that case it is very easy to get the brokerage account from this kind of traders. So I have opened a bank account when I was out of Bangladesh in the Barclays Bank. So I had to take the Barclays Bank statement. I had to share that statement with the trading 212 to get the account cleared for me. Okay, but I believe that if I would give the bank statement of my local bank, I would not get the permission to get the BU account.
স্যার ফরেন ব্যাংকের বাংলাদেশ ব্রাঞ্চের ব্যাংক অ্যাকাউন্ট দিলেও তো হবে স্যার?
Maybe, but I'm not pretty sure for that. Okay.
ওকে স্যার, ওকে স্যার, থ্যাংক ইউ স্যার।
Okay. The thing is that you need to feel that though sometimes we have illusion of control bias, we need to recognize that investing is a kind of probabilistic activity. No one has control in this wide market and heavily participative market. The thing is that you are very likely to listen or see the news that Elon Musk has become the richest person in the world for having the higher valuation in Tesla, in New York Stock Exchange, and in other stock exchanges. But the thing is that you also need to be prepared that when you will see that Elon Musk has become the 10th in the list of the person who are trillionaires or who are billionaires. Okay, yeah, you are very likely to see the two types of news. Okay, so what does it mean? It means that even the Jeff Bezos does not have any control in the stock market. Okay, so if Jeff Bezos feels that he has a control in the stock market, it is very unlikely. It is a kind of illusion. Okay, so in that case, just think of that how the kind of marginal investors we will face the consequence if we have the illusion of control biases. Okay, so it is always advisable to seek the contrary viewpoints which challenges our views. And the thing is that, which is very important, is that this one, why we fail, when we will not fail. It is ultimately achieved by those who can conquer the daily psychological challenges and maintain a long-term perspective. Okay, so say after buying a stock, people feel that his price is going down. After selling a stock, people often see that that stock is going up. Okay, but people forget this. Okay, people only see this, a portion, but people tend to look at what will happen after this. Okay, so we need to have a very, what kind of perspective, intermediate term or short term? We need to have a very
long term
perspective. Okay, then hindsight bias, we probably have given the example of hindsight bias in earlier class. That is, people feel that the thing what has already been happened are predictable, though they didn't predict it well, or they actually predict differently. So it has been said that when the decision process is poorly reasoned decisions, but you have seen the positive result, you feel that it was your brilliant decision, and that decision has been taken by you well. But if it has been found that you have taken a very well constructed decision, but the result is poor, the result is not good result, so you feel that the mistake could be avoided. But the issue is that what people tell after getting the result are kind of dishonest response, Okay, so in that case, the issue is that what people try to demonstrate that they have a very overconfidence kind of, or they try to overestimate their initial knowledge, and also people try to forget that they actually didn't make this prediction, but now they are claiming that they did this kind of prediction. So the thing is that what we need to do, we need to avoid this kind of false sense of confidence. I have mentioned that is a kind of dishonest response. So we need to avoid this false sense of confidence. Okay. So say out of the 6 questions you face in the final exam, you have expected probably that only 20% cases that 2 questions will repeat from the previous questions. It is not the case that in 80 you are 80% confident that 2 questions exactly what you have picked from the previous years will be repeated. But after getting this exam, after getting these 6 questions in your exam, after coming out from the exam hall, you feel that I was 80% confident that these 2 questions would be repeated in the exam. Do you exhibit this kind of bias?
Yes, sir.
So in this case, what we need to do, one issue is that we need to be honest by ourselves. We do not, we cannot exhibit dishonesty. We need to record our decisions every time, what we are doing, for what purpose we are doing, so that we can avoid the mistakes later. The remaining biases what are to be presented now are not cognitive, are not belief preservance bias. Rather, those are more related to information processing bias. So if I want to estimate, if I want to ask you that what will be the GDP growth rate for Bangladesh in 2023, give me response.
So 7 to 9%.
7 to 9%. Okay. Any other response? Any other response? No other response. Is it expensive to give you a response? That means you have to spend 100 taka for giving a response?
No, sir.
So you can share your estimate. You are wanting to become analyst in the market, and you need to have this kind of numbers in your mind.
Sir, I do not trust this kind of numbers that are reported.
Okay, I'm not asking for any reported numbers. I'm just asking for your estimate, like you are a World Bank. You want to give us some number like this. Okay, who has said 7 to 9%? Shagor?
Yes, sir.
Okay, why you started from 7%? From
Sir,
where this 7% has come?
স্যার রিসেন্ট যেই জিডিপি গ্রোথ রেট স্যার
Okay.
এটা কন্টিনিউ করবে ইন ফিউচার, এটা স্যার আমার প্রেডিকশন, যেহেতু আমাদের ওয়ার্কফোর্স আরো বেশি পার্টিসিপেটিভ হবে, আমাদের ওমেন যে পপুলেশন আছে তারা ওয়ার্কফোর্সে আরো বেশি পার্টিসিপেট করবে, এবং তার জন্য স্যার জিডিপিটা 7 থেকে 8% দিকে অথবা 9% দিকে যেতে পারে।
Whoever is doing the prediction, we do not know what is going to happen in 2023. It may happen that Bangladesh GDP size has become double, growth rate 100%. It may feel that Bangladesh GDP has contracted down to 50% or contracted down to 20%.
সেটা হওয়ার পসিবিলিটি খুবই কম।
But you cannot rule out that there is no possibility of getting this. We never have realized that COVID-19 will visit us and it will close down the world on a very short notice.
Yes, sir, that's true.
So how much possibilities we gave this kind of event? 1% or less than 1%? But now what is happening? Okay.
স্যার এরকম কিছু স্যার আউটলাইনার তো থাকবেই, অথবা স্যার এক্সট্রিম
The thing is that what we do not make any absolute production like this. We try to start from kind of anchor. Say you have started from 7. You have started from 7. This 7 has come from some existing number, and you want to adjust that number for in some positive direction or in some negative direction. People have a tendency to avoid estimating any absolute figure. People have a tendency to estimate some number which is related to the existing number. Got it?
Yes, sir.
Okay, so that is a kind of anchoring bias. The thing is that people, when you go for purchasing Robi, for example, today, should you look at the purchase price 63 to conclude that whether it is overvalued or undervalued? Or you need to get the, say you need to get the target price 15, and then you will conclude that it is overvalued or undervalued. But just by looking at this, you cannot say anything.
So target price 15 is also overvalued.
That means you need to have you need to have this kind of comparison. But people often likely to say that this is 63 is my purchase price. That's why if it is 70, then it is fairly traded. But if it is 30, it is undervalued. Is it the right way? What we are doing, we are comparing with our purchase price, right?
Yes sir, anchor করতেছি.
Yeah. So that is not the right way of making decisions. So we need to ask that are we making any biases, or are we looking any bias? Are we having any biases for making recommendations? And we need to do rational analysis for making any recommendation or making any forecast. And we do not the consequence of the illusion, it is not the, it is anchoring bias, it should be anchoring. So it has been found that, say, right now, say target price for GP is 370. It may be, for example, you are doing valuation analysis, a very independent valuation. So you have found that the price is some like 600. For example, the target price for 2021 December. But what you are doing, instead of presenting this 600, you want to get a number by modifying your valuation, which is not very far from 370. You want to see the number closing to 390 because you feel that 600 is not very is very different from 370, the current price. Okay, so people have a tendency to present a target price, or even after having new information, people have a tendency to get a target price which is closer to the existing target price and or existing target. Okay, so this kind of biases we need to avoid. Then mental accounting, you already have learned about it when we talked about the behavioral portfolio construction processes in previous class, that people have a tendency to group their assets into different non-fungible mental accounts. People form the mental accounts themselves. But the thing is that the money is not really non-fungible, money is fungible. It may seem that uh, our father, or not our father, my father has 3 shops, and one shop, revenue from one shop is spent for my college education, and revenue from another shop is deposited for his retirement benefit or expenses in retirement life, and one shop revenue is maintained for or protected for having some long-term goal. Okay, but you see that we have not included 3 shops in a single portfolio, and we have not considered what is the aggregate outcome of this asset, what is the aggregate risk of this asset, and we have not also included the correlation among these 3. There are very high correlation among these 3 shops. So we have not included this when we exhibit mental biases. So it may be such that for ignoring such kind of correlation among these, we may end up doing some poor allocation. And we also, when we exhibit the mental accounting bias, we like to not differentiate between the capital appreciation gain and the current income gain. You probably are familiar with this current income and the capital gain. Both are sum to total gain. Which one you should focus? This one, or this one?
total gain.
You should focus on total gain. So for the people who exhibit mental accounting, sometimes they look at only the current income, ignoring the capital gain. For example, if you buy a very high yield junk bond or high yield junk securities, it may give you very high return in several years, but it may be like that it has lost its total value and you have lost your capital. You have no investment later. Okay, so we need to think from the total perspective, and for that reason we have to avoid the kind of mental accounting bias, and we need to accommodate, or we need to think our risk return from the total consideration. And the final one, I like to conclude by mentioning the framing bias. We already have uh, our time elapsed, but framing bias is related to our discussion on the behavioral portfolio construction, that people responses differs based on how the questions are asked to people. Okay, now if I ask you that COVID-19 vaccine A and COVID-19 vaccine V, okay, between these two vaccine, if I ask you this kind of question, that if we use the vaccine A, uh, 200 people will be able to save their life, and if vaccine B is used, there is 33% chance of saving 600 people, all 600 people, and 66% possibility of saving no one. Which one you would prefer, vaccine A or vaccine B?
So both are equal.
Hmm?
Both are the same.
Both are the same.
Yes, sir.
Okay. What about other response?
স্যার ভ্যাকসিন এ তে স্যার কেউ মারা যায় না?
মারা যায়।
I have not given any negative
এখানে
statement to you.
probability assign
Just
করা
think of
হয়নি
the
এখানে।
positive. Just think of the
Vaccine.
positive, that if we use the vaccine A, 200 people will be able to save their life. And if vaccine B is used, out of 600 people, 600 people has a chance of saving 33% of their life. Which one people will prefer commonly?
So people will prefer vaccine A.
People will prefer vaccine A.
Okay.
Okay. But the thing is that, I mean, people are now risk averse here.
Yes, sir.
People are now risk averse. But if it is such that I have given you just the opposite statement in the negative perspective, that if we use the vaccine A, 400 people will die. But if we use the vaccine B, a 33% chance that no people will die, 66% probability that all 600 will die. Which one will be preferred by people?
So people will prefer B, but both are the same.
Obviously, both are the same, but if you want to save more life,
Yes, sir. People will prefer vaccine B.
people will prefer vaccine B. In which
Yes, sir.
case, negative framing or positive
Sir,
framing?
negative framing.
Negative framing. Okay. So in this case, people put response for 72%. Here it has been found that 22% supported this. But are not these two statements similar or exactly same, just the opposite part of flip coin?
Yes, sir. They are exactly same.
They are exactly
Vaccine A,
same,
vaccine
but
based.
the way of framing the questions are different way. Okay, this is the way how doctor ask you when there is a question of giving you some kind of difficult treatment, where there is also chance of success, there is a chance of failure, that our patient will not be able to survive or our patient will be able to die. There is equal chance. Okay, but if it is like that, the statement is a kind of positive, people try to exhibit risk averseness. But when the statement is kind of negative, people try to exhibit risk loving tendency. Okay,
সো এরকম টেকনিক বর্তমানে স্যার নিউজ রাইটাররা স্যার অনেক বেশি ইউজ করতেছে।
yeah, that is the way how the framing is used. That is the way how framing is used to influence the people perception. Okay, so the thing is that always it influences you, your acceptance of taking risk will be influenced. Okay, say I'm giving you two assets, risk and return. Okay, I have said that this will give you 400% return and this will give you 15% return. Which one you will prefer? A will be preferred commonly.
No,
But if I
sir.
say there is a volatility of 50% and there is a volatility of 5%. Okay, it is also way that if you put the return here or if you put the risk here, I mean the column number, if the risk column in the first and the return column is the second or the vice versa, the response will become different.
Yes, sir.
Okay, that is the way how framing bias works, and we always need to be neutral and we need to be open-minded as possible when interpreting investment related situations to client, so that client will not accuse ourselves means we are the asset managers, when they will feel that their decisions would be different if there was no framing bias. Okay, so that is all about for today. I think it is enough to digest for today. So we'll start by mentioning about availability bias in the next class.